Hi, this is Steve Hutchinson with Hutchinson Family Offices with our monthly video. I want to take the time to bring you up to date regarding our economy, the financial markets, as well as our insights into what may affect you as an individual investor. Briefly, let's take a look at what happened in June following the Britain's Brexit vote. As in a video we released earlier, the effects on the financial markets were really of no real consequence whatsoever. We weren't very concerned about it at the time, and we do not believe that it has a lasting impact on our financial markets, nor does it have a lasting impact on the global economy. So we dismiss that pretty much as hyperbole. Secondly, even though we cannot predict where the financial markets are going to go, financial markets often do their best after a sharp pullback. And that's one of the reasons we often say is let information digest, let it get out there, and then make a decision. And that's what, if you did that, that was a smooth move. You did very, very well. Now we see the financial markets become a bit overextended at these levels, but we're very positive as far as the overall corporate earnings seems to be coming in, not stronger than we expected, but overall meeting expectations. We see a close above the S&P 500, looking at the S&P 500, close above 2,200 as a very positive situation. And we think that if we do see that in the coming weeks, we could actually see a very strong market moving into the fourth quarter of this year. We'll keep our eyes on that, but that is something that we are taking a look at. Secondly, let's talk about the Federal Reserve. Federal Reserve held their open market committee meeting in June or end of July, and basically left rates unchanged. Now, we're not totally surprised by that. We have not expected rates to be increased for significant reasons. Number one, we don't believe the employment market has improved significantly. And also to the GDP or the growth of our economy is very, very stagnant. So we're very cautious in saying that the Federal Reserve will increase interest rates. Although it's not beyond the scope of increasing interest rates, say sometime in the fourth quarter, and this may be maybe a token quarter point increase just to show they're in charge. But overall, we do not see interest rates trending higher. It's not something that we're really particularly concerned about right now. Also, too, GDP, really, there were a lot of Pollyanna economists and folks that really felt that the paper hat economy that's been created over the last 8 to 10 years, it was going to grow much better, say somewhere around the 2% range. Clearly, we're not getting 2% growth in our economy. We're getting somewhere around a 1% growth. And unfortunately, the specter of a recession is still on the horizon if we don't see an increase in the economy. And that's something we're going to be looking at very, very closely. We see the revisions of GDP growth in the first 2 quarters of this year somewhat a bit concerning. Again, the possibility of a recession does loom out there, and we are keeping our eye on that closely. Consumer spending still continues to be the driver for our economy. Consumers are out there spending, they're vacationing, they're having a great time, they're dropping their paychecks, if you will, in the stores. And so we expect that to really kind of buoy the economy. What we're not seeing is we're not seeing business inventories build up. We're not seeing strong purchases in what we call more industrial goods, things of that nature. And we've got to see that in order to feel real positive about the economy. What can we expect in the next few weeks? Well, I think it's basically going to be more of the same. I think the volatility is traditionally slows down right here before Labor Day. And as we move into Labor Day, volatility will start picking up. There'll be some attention paid to the election. Although election trends generally do not affect the financial markets over the long term. But we do expect a little bit more volatility. One of the things I want to talk about today, though, is what I consider the number one nomination for overvaluation, which is sovereign debt. You're earning nothing or less for the privilege of lending your money to a government. That's basically what happens. If you take a look at the 10-year Treasury the interest rate is hanging around somewhere around 1.5%. So if you lock your money up, loan it to the government for a period of 10 years, you're going to earn 1.5%. What you have here is the central banks of the world are striving to achieve an inflation rate of 2% or more. Well, if you back out that 2% inflation rate from what you're earning on your sovereign debt, your rate of return is zero. And you know, today sovereign debt represents a significant risk as the world banks, as the governments, the money governments are forcing down interest rates as they're trying to, if you will, stimulate their economies as much as they can. The experience of losing money is common in investing, but where certainty of loss is something, even before the check clears, that's not something that we're particularly excited about. So we're very cautious about sovereign debt, including U.S. debt. We're going to start looking for alternatives in that area. Generally speaking, we feel very strong about, as the summer winds up, we think that the election is going to provide a lot of fireworks. I think the financial markets and the talking heads, they're going to go out there and they're going to tie a word that someone says to some type of market movement back and forth. But overall, we still see corporate earnings remaining fairly solid, but we do not see the economy growing at the rate enough where the Federal Reserve would get into a pattern of increasing interest rates. That's it for this month's video. I want you to continue to have a great summer, and we'll be bringing you up to date here very soon. Thank you.